Ladies and gentlemen, good afternoon and welcome to this webinar brought to you from Nadaq Dubai's market site. With me today is the Chief Investment Officer of Franklin Templeton here in Dubai, Mohideen Cromful. Dino, thank you for joining us.
It's a real pleasure. It's good to be here.
So Dino heads Global Sukuk and MENA Fixed Income for Franklin Templeton. Additionally, he's a board member and he's also a founding partner of the DIFC entity when it was set up back in 2006. With over 25 years of capital market experience here in the region, Dino is one of the go-to guys when it comes to fixed income investment landscape, which is what we'll be discussing on this webinar today. We will be taking questions, so please do post your questions through the Q&A box at the bottom of your screen, and we'll try and answer as many of the questions throughout this webinar as we can. So Dino, having spent so much time working here in Dubai and in the region, you've really seen the regional markets develop and you've played an instrumental role when it comes to promoting the regional markets. I'd like you to start by asking you to give the audience an overview of the macro outlook in the region and globally, please.
So thanks again for this very kind introduction. It's a real pleasure to be here, and I'm really happy to be really collaborating now on another initiative really with Nasdaq Dubai. So yeah, the region is going through a pretty challenging time. I mean, it's obvious that the lower oil prices presents its own set of short and medium-term challenges. Clearly, we have the virus as well, and I think that both of those are obviously having pretty profound implications. But on the other hand, I think the world is also going through now an extended period of very low interest rates, and you can really see that across the world. I think the last time I checked, something like $15 trillion of bonds were trading below zero. And if we look at the rest of the developed markets, they're all now trading, we used to say below 2%, now it's even below 1%. So we are in this very low interest rate environment, and in many respects because of these challenges that we were just describing. But what this has meant is that a lot of money, I think, continues to flow from these large, very well established developed markets into higher yielding emerging markets. And so what this has meant is that the demand or the need, the ability to finance, I think, the shortfalls that the region is now facing, is being met by this increased demand and this low interest rate environment, which is driving more and more investors to the region. So that's in a sense, something that is quite positive about the global environment that is somewhat supportive of these very challenging domestic environments. But this is also coinciding, obviously, with medium-term challenges that the region has to address. And these are everything from, transition to a lower carbon economy. It's the need to diversify their economy. So there's this ongoing tension. And so, and then obviously I would say the declining or deteriorating credit fundamentals of the region, all of those are coming into play. But by and large, all of this means is that the regional fixed income markets are now poised to play a much more important role in the evolution of the financial markets and the evolution of the region's economies. And also, I think, in the portfolios of investors going forward.
Okay, very good. And so look, when we look at 2020, I think it's a year none of us will forget. What has happened is something we really didn't expect. And for the region to play this key role in when it comes to the global market, can you just give us a sort of overview of how the regional fixed income market has been so far in 2020? And how do you see the rest of the year panning out for the market?
So, I mean, this is still a region that is fairly high quality. And, the reaction, obviously, to the crisis and to the oil price collapse was similar to other parts of the world. We had this pretty significant drawdown. It felt like the markets were broken for a period of time in March. But thankfully, I think because of this very sort of decisive intervention from the Fed and other policymakers, including the IMF, all of this liquidity found its way from the developed markets, slowly into the emerging markets and into our markets. And, the healing process sort of began. And the recovery was relatively quick. I mean, within 3 months, we were back in positive territory.
Expected.
Yeah, and also the markets opened up. So you can see issuance on a year-to-date basis is already up to like $70 billion. We're on pace to exceed last year's issuance. And this is one of the things that I was talking about. So despite these challenges, I think because the global environment, on a relative basis, the region is still attractive. And so what that means is that despite the pressure to issue more, or the need for more financing, that has been met with record demand.
Yeah.
And as we go forward, we expect that to continue to be the case.
Okay, no, very good. And I think when you mention money flowing from developed markets to emerging markets, obviously emerging market inclusions have brought an inflow of funds to the region over the recent years. How have the inclusions helped the fixed income market? Because we always hear when you're talking about emerging market inclusions and countries getting ID, you always hear about the equity, how much money is flowing into the equity, but fixed income is as important. So how has the addition to the emerging market status helped the fixed income market in the region, and how would you compare GCC to other emerging market territories?
So that's very true. You're right. Policymaking in general here for the better part of 10 years has really been focused about the equity markets. And the transition or the journey for the equity markets has been a multi-year process in general. And I think it continues to be one that has some more development to go forward. Bond markets, however, just because of the different nature that fixed income indices play, that transition happened within the space of a year. JP Morgan changed their index criteria at the end of 2018. By 2019, the process has started. And halfway through 2019, as the GCC was becoming included in the index, most people weren't even aware of this transition. So here we are now in the middle of 2020. And the region represents a very significant part of these emerging market indices. And this, I think, is very relevant because, the development of emerging markets is the single most important development in international finance. Emerging markets today represent 20% of the global fixed income landscape. I think something similar on the equity side. And what we were referring to earlier is that this money, as investors continue to seek returns, more and more money, I think, is going to be moving into these emerging markets. And so for the GCC bond markets to now represent such a significant part of the emerging market landscape, it lends a lot of, I think, or it validates the idea or the thesis that, the region should be able to absorb or should be able to finance what it needs going forward, provided, of course, that as they issue more paper, they're also, continuing to make progress on, protecting investor rights, on developing their legal infrastructures, improving their bankruptcy regimes, their ESG metrics, and so on and so forth. So these are all, I think, important developments. But there's no doubt that the size of the GCC within the emerging market landscape is still something that is underappreciated, and investors, generally speaking, are underweight the region. And we think that this is now a multi-year process where we'll continue to see more and more foreign investors participate in the markets, and more local or regional institutions allocate more to regional debt markets, because the risk-return dynamics and the investment characteristics of the asset class have been so attractive. And so going even back, if you allow me a second, on this idea about investors seeking returns. When we say investors are seeking returns and they're going from these developed markets into emerging markets, we almost say it as if, investors are somehow making a mistake, or they're, this risk-seeking behavior is going to end up in a catastrophe. But it's actually based on pretty solid data, or pretty or very reasonable, if you want, history, in the sense that if you look at the asset classes with the best risk-adjusted returns over the past 10 years or the past 20 years, it really comes down to two or three. One is U.S. equities, and so you can imagine that continues to, I think, be an important allocator. But it's really credit, investment-grade high-yield credit, and external emerging market debt. And because the GCC, generally speaking, issues dollar debt and is of higher quality, it is actually the part of the emerging market landscape that I think has delivered the best risk-adjusted returns, and I think is one of the very important, I think, foundations for it to continue to receive this money.
And when it comes to just to look at sort of that change from investors' mentality who have been focusing on developed markets and now moving towards the emerging markets, have you at Franklin Templeton seen significant number of your investors who are looking more at emerging markets now compared to, say, 2, 3, 5 years ago?
So in general, I think, our firm as well as other firms, have seen their emerging market portfolios or their emerging market strategies grow in size. They're becoming more popular. It's becoming more of a core allocation. And as an organization, we coined one of the term emerging markets. We were in fact known really outside of the US. Franklin Templeton really is known for its emerging market strategies. And it has been in the region for over 20 years. And I think when it comes to the GCC bond fund, as far as I'm aware, we're the only sort of international asset manager with such a strategy. And we've been running this now for the better part of 8 or 9 years. So certainly as an organization, we saw the value or the benefits of investing or focusing on these markets. And I think now we're at the stage where the rest of the market is going to be catching up. And, we expect a little bit more competition for certain, but we think the pie is also going to be getting bigger.
Okay, very good. And look, one of the things I want to talk about is when you mentioned risk, and one of the key things at the moment is defaults. Since COVID-19 pandemic started, people have been talking about the defaults in the bond market. Investors may have been a little cautious, if I may say. Of course, there's pressure on governments, and many have issued multiple stimulus packages. Earnings for companies have been affected because of the pandemic and the lockdowns. What has been your view when it comes to this sentiment around the possibility of seeing an increased number of defaults? And what are the key attributes that give investors comfort? Should we be worried here in the region when it comes to defaults and seeing an increased number?
In short, no. But let's go back a little bit. So first, when the crisis happened, I mean, we knew that oil prices were very low, and we knew that the credit trajectory was going to be very challenging. I mean, across the board for sovereigns, for banks, for corporates. But there were also some unknowns that slowly became a little bit clearer to us. First, we had, as I mentioned, the intervention. Oil prices started recovery again because of the support. But also, I think importantly, a lot of the policymakers in the region also came out and were pretty clear that between spending quite a bit to mitigate the impact of the virus towards having a more, in my mind at least, and certainly in the eyes of the market, a more sensible approach to mitigate the virus, but without removing the anchor on their fiscal policy, I think was very positive. So if you think about it, the region chose not to spend so much, chose to consolidate their fiscal balances, chose to be very careful about what they were, projecting to the market. And I think that really helped, contain the pressure on the currencies, helped contain, I think, the pressure on their spreads. And while yes, they've done several, I think, different efforts to try to help banks, for example, through some forbearance measures, but by and large, they did not allow their spending to go unhinged. No doubt, they're going to be facing significant fiscal pressure, but at least in the eyes of the market, this will be relatively short-lived, and for the majority of the sovereigns, they can afford it. So that was, I think, a very important development.
Okay.
As far as the other markets, or other issuers, banks are another very important part of the market. And by and large, they also have come into this crisis in a very strong position, especially relative to other banking systems. Very highly capitalized, their asset quality levels are good. And so while things will deteriorate, and we already see that in a lot of their earnings, down in some cases 80, 90% as a provision, but they have the capital buffers, they should be able to deal with this. And while we expect some deterioration, they'll certainly come out, at the other end in pretty good shape. Now, for the corporates or the industrials in the region, they also, by and large, have lower levels of debt than other parts of the emerging markets, certainly much lower than the developed markets. Their businesses are, generally speaking, quite profitable, they have good margins. And so while most of the pressure is on corporates, because when we think about the virus, we don't know when it's going to end or what its impact is ultimately going to be on these corporates. And if a country will be around in, say, 3-4 years, you're less sure of yourself when it comes to the corporates. That's why they continue to face, I think, more pressure, and they're a little bit under pressure now. But again, most of the corporates in our part of the world that have accessed the markets are the bigger corporates. They're in pretty good shape. So again, we don't see still default levels being alarming. We see them having ticked up. For example, last year they were up on the back of, again, a structured finance deal, if you remember, with Ittihad. This year, we already have a default. But both of these defaults, in fact, have little to do with the economic activity. They have much more to do with corporate governance breaches and failures on that side. But when it comes to fundamentally driven defaults, real estate and so forth, we expect there to be some of that. But we're talking 2-3%. Our forecast for next year is, for 2020, is 4%, and you've got to be comparing that to low teens in the U.S. and in other developed markets. So yes, defaults are going to pick up, as they naturally will as your market develops. I mean, we're a $550 billion market today. So you're going to have some defaults, but I don't think it's alarming, and I don't think this is a cause for concern, especially when half of these defaults have more to do with corporate governance and other breaches, which we can speak about later, because that's certainly an area where we can have some improvement.
Okay. We're going to talk about the sort of growth of the market and the potential, but we've got a question which I'd like to from one of the members of the audience, which I'd like to put forward to you. The question is, with global yields or spreads so tight, is there any value left in GCC credit? Have new investors missed the boat?
The short answer is no. I mean, we are still today wider than we were before this virus, and then on a relative basis, I think the GCC continues to have more value relative on a per unit of duration or relative to other similarly rated countries. And then again, I tell people that again, it's difficult to time markets. I mean, I wouldn't approach the decision to invest in the GCC as in did I miss the boat for this month or this quarter. I mean, I look at it more as a multi-year process, and I feel the story for GCC is really this combination of a market development story, because we're going to continue to have more issuers, more companies, more growth in the asset class, and it's a structural reform or a market development story. We're going to continue to see, and this is an important part of the policy response, is that between spending so much or continuing down this pace of structural reform and economic diversification and developing their financial markets, the policymakers have chosen the latter. So I think when people invest in the GCC, it should be over the medium to long-term view. Spreads will go up and down a bit. Interest rates too can fluctuate, but I think the decision to allocate to the region is very sound, and I think is more of a medium-term outlook that people need to be considered. And even I get surprised by how many regional or people based in the region allocate so little to the bond markets that you can sense and smell around you, right? Because these companies. But I think there's still a lot of growth coming from local or regional investors, as well as I think international investors.
Definitely. So opportunity is there, and look, one of the things that may be holding back that growth potential in the region's fixed income market is the fact that we keep seeing the same issuers going to market year on year. We're not seeing enough new issuers. You'll get a handful of new issuers each year, but there's just not enough, considering how big this market is, for new issuers coming and access to the market through fixed income. Do you see a greater number of new issuers tapping the fixed income market in the coming years as the market develops and we get more investors interested?
Yeah, so I mean, I don't think the market is that small anymore. I mean, I recall when we used to promote, equity capital markets. If you had 150 issuers, 150 names to invest in, that's a pretty significant market and a good rationale to now outsource the research work that needs to take place. I mean, in our bond markets, these are the numbers that we're looking at, right? There's 140 names more or less that we're looking at. They're increasing at 1 to 2. I agree with you that we still have a very high concentration of financials, and sovereigns, again, are a big part of it. But if you look at the sector representation, it's pretty diverse. And I think today you can really build portfolios that are fairly diversified, whether you're looking at education or transportation or real estate or airlines or telecoms, or, I mean, pretty much you have a pretty wide mix. And there's still more, I think, that can come in. I mean, I was looking at the if I look at the MSCI Arabia Index, or I look at the Saudi Arabian Index, there's a number of, I think, petrochemical, industrial companies that have very low levels of debt, or in fact that have so much debt, but all of it is in bank debt. So I think the opportunity to see more issuers come in is certainly there. My hope, though, is that we start seeing more private companies and more high yield companies come into the market. And then by extension, and I think this is the big opportunity I feel, is the private markets also have a very important role to play, I think, as we think about debt markets going forward.
Okay, good. So even if we start seeing new issuers, do you think that investment characteristics have changed since the pandemic has started, or are investors still looking for the same thing?
So when we talk about the investment characteristics, especially the defensive ones that we like to promote, I mean, it's one, low levels of volatility, low correlations to other asset classes, and smaller drawdowns.
Okay.
Now, because of the combination of the virus and the oil price, certainly we had a big pickup in volatility because it was a pretty volatile period. But if you look at us on a relative basis, the drawdowns were a lot lower than high yield or emerging markets. So in some sense, I think that the market really delivered on the smaller drawdowns that we were talking about. And the bounce back was also pretty impressive. I mean, fairly quickly, we were back in positive territory. I mean, the index is now up, I think, 3% or 4% year to date. Same for the funds in the region. So I think that the higher quality, the contained vol, although it's higher, and the smaller drawdowns all continue to be in place, and I think will persist. But as the market grows and as the credit deteriorates, and more foreign participation, or the foreign participation increases, I do think that some of these investment characteristics will evolve. And so I do think that the quality will continue to deteriorate, and I do think that the volatility will pick up a little bit. But on a risk-adjusted basis, I still think the region will continue to offer very good value.
Okay, so I'm going to move on to another question after that's coming after this response is, given current uncertainty and volatility, have you seen or do you expect to see an increase in portfolio weightings towards shorter duration securities or toward cash and cash equivalents?
I think that comes down to preferences. I mean, I think people should expect some volatility. I mean, we are in a fairly challenging environment by any understanding of what's happening globally.
And markets won't be fine if there's no volatility.
And you can argue that the volatility has been suppressed because of all this intervention that you have. But we could very well be on the eve of major regulatory reform as well. Obviously, it depends on a lot of different factors, but it's certainly not out of the question. And so the amount of cash that you hold, or the amount of tail risk hedges that one puts in place, whether it's about currencies or gold or things of that nature, I mean, they seem to be, in my mind, quite sensible. But the question on duration, you've got to be thinking that this is now not such a immediate concern, or not even a medium-term concern. I mean, I think policymakers are going to great lengths to make that very clear. You're unlikely to see higher rates, and if there is worries about inflation that materialize going forward, it will be reflected in longer-dated securities. But I think there's already quite a bit of cash on the sidelines, and I don't think those will necessarily increase. I think, if anything, people will continue to extend duration, and they will continue to see credit risk, which is the same behavior we said has been going on for the better part of 10 years now, and we think has more to run.
And then continuing with the theme of investor sentiment, when you look at equity markets, I see investors are very bullish on sectors such as tech, healthcare, online education. There's certain sectors which they're moving away from for the short-term period. Is this the same for fixed income? Are fixed income investors shying away from the same sectors as equity investors are? For example, we had EMBD list their bond with us last week, and they had very good oversubscription rate on that bond.
That's a great example to bring up, because if you look at the banking, banking stocks, I think they're all suffering because of the intervention, the lower interest rates, the expectations for lower margins. And we were just talking about them having to provision. And so therefore their net incomes are all getting hit. So if I look at the worst performing sectors on the equity side, banks would be one of them. But you're right. I think when it comes to the bonds, I mean, those are perceived as high quality issuers. They enjoy strong balance sheets. They can withstand the impact of a year or two of bad earnings. Many of them have an interventionist central bank or government that can support them. So they're generally perceived by fixed income investors as quite safe. And when spreads widened during the crisis, that was one of the areas that where money went to. Other sectors like telecom, I think it's been a little bit more neutral on the equity side, and it's been the same, I would say, on the fixed income side. But then other markets that have done well on the equity side, I think things related to food or healthcare or industrials, those are, generally speaking, they were either neutral to slightly negative, right? Because we don't have that much choice on the fixed income side. And in healthcare, we had the NMC fiasco, which cost people quite a bit of money. And then other industrials, depends if they're high yield or not, has an impact. If they were, because we had this bifurcation, high yield issuers continue to be under quite a bit of stress. Whereas on the equity side, they look at the upside. Obviously fixed income markets, they're more worried about losing their money. So I guess in some sectors like banking, it's almost like the opposite view. In some sectors like telecoms, it's a little bit more neutral. And I think with others like, healthcare or industrials, it's a little bit more nuanced. With more favor or I think more of a liking by equity investors and fixed income investors.
Okay, good. And look, I always say the region is still very young when you compare us to other capital market centers. There's so much potential, so much for us to look forward to. What does the future hold for fixed income in the region? And maybe you can go beyond fixed income a little and touch on capital markets in general or the overall economy. What is it that you're going to see?
So we are definitely at a relatively early stage, and I think the future is very exciting. Obviously, I think there is a big growth story to our region, and I think this is definitely going to underpin a lot of this enthusiasm, right? I just think there's going to be much more growth, there's going to be more participation, and that's all going to be very positive. I also think that corporates, generally speaking, don't hit above their don't hit at their weight. Still, as a percentage of the overall market, it's still small. So I hope that we start seeing more corporate issuers, and by that I mean some of the larger national champions across the region. Too many, I still think, are not involved in the debt markets, and I think that can be an important source of diversification. I'm also hopeful that we start seeing more high-yield issuers as well, and more independent corporates. I think that's something that the region desperately needs. I think a lot of those entrepreneurs and business people need access to the bond markets, and they need to diversify away from the banks. And so I hope the bond markets can accommodate them.
Okay.
I also see a lot more local currency issuance. So when we touched on issuance, if you recall those charts that showed the region issuing so much debt and being such a big part of emerging markets, that was external dollar debt.
Okay.
But last year, 47 billion equivalent in local currency was issued. And if you look at the wider MENA region, their local currency debt markets in Egypt and other places are also, I think, quite interesting spaces over the medium term. And you can already see Saudi Arabia, Kuwait, Qatar, all these markets now taking steps to reform their local currency issuance. Because in my mind, this is a very, again, important development. They need to develop, and we're in the process of developing local bond markets. And again, if you think about the long term, this is a region that is trying to go through a very important economic diversification. They want to move away from oil and oil-related activities. And if they are successful in that, you have to be thinking that the peg that has served us so well for the past 30 years is probably not going to be with us for the next 30.
Okay.
But I think before you're in a position to remove the peg, you need to really develop these local bond markets. So I feel that these are going to be now much more important. They're going to develop fairly quickly. So I see that in our future. But all of this is also coming with some headwinds, right? I mean, clearly the region is going to continue to be dealing with I think one of the biases that people already have to the region. So people think of this region, they think about what, terrorism and very volatile oil prices, and they attach the two. And I think this is an area that I think the region and we need to do to set things straight. It's on a risky market, and if anything, adding the GCC to your portfolios reduces your risk because of the characteristics we were talking about. But also, the transition to a low carbon economy, I think, is something that is also important. How is the region going to address their use of energy demand, their water subsidies? How are they going to, make sure that there's more for export versus, local consumption? These are all, I think, very relevant topics. And in general, investors are increasingly going to demand much more information, more data. And they're going to need to evaluate and consider their ESG-related risks. And this is an area that, again, I think the region has been doing very good progress. If we look at our ESG scores, you'll find that places that you wouldn't think of, like Saudi Arabia, like the UAE, are the ones making the most progress in the region. But people are, generally speaking, think that we're actually going backwards when in fact we're moving forward. But this trend will continue, and we need to be very conscious of it, because while today it doesn't affect pricing, it very well will. And if you think about technology and all that is happening there, it's only natural to think that in addition to considering ESG, we're going to be searching for data and wanting to use data to make investment decisions. And this is another area where the region is a bit challenged. So take now, people are assuming the worst about what's going to happen to the population in Dubai, or what's going to happen to the number of people attending schools, or what's going to happen to the economy, because we don't have the data.
Data's not there,
right? Or if it's there, it's late. Or so this is another major area where I think there has to be quite a bit of progress. But all of these, I think, create opportunity, and I still think that when you have a strong growth story coupled with a structural reform story, I think the combination is very powerful for the bond markets of the region.
I think so. On your earlier point when you spoke about private companies, private organization, corporates going to market, I think that's a big step for them, because going to public markets, you're opening up. You're opening your books up. You need to start offering that data to investors for them to be comfortable. And I think that's a big change for a lot of these large private companies, which we would love to see issuing fixed income or accessing the public capital market. So that's something important. And we did have a question around ESG from one of the audience members, and you've touched up on ESG, and we're seeing that ESG is becoming more and more popular. Sukuk-wise, there's many Sukuk now. IDB's done it, the government of Indonesia has done it.
They're doing green Sukuk,
are looking at green Sukuk. So the Sukuk market is developing. Now, we had the slide that we all had up on the screen just shortly spoke about, it showed SMEs.
Yeah.
Now, that's something very important, because when you've got a place which is made up of 70 to 80% minimum SMEs, that the economy is made of SMEs to that level, SMEs can play a key role to the capital markets as well.
And this is something that I think we, through the launching of private debt funds, which we're doing, and hopefully will be up and running in the beginning of next year. But policymakers, everyone, I mean, banks by and large, have not been very good at lending really to that sector. And if you look at this chart here, you look at the different benchmarks you can to evaluate the competitiveness of banks in the region, there's a good argument or a strong argument to make that they're not that competitive. And so as we go forward, for a variety of different reasons, it's really good to disintermediate the banks. I mean, we don't want banks to continue to represent such a large part of our financial services. It's useful to have insurance companies, pension funds, which the DIFC launched this year, which is a great development, I think. But also having different allocators of capital through private debt or private equity funds and the like. And especially during times like the virus right now, I mean, there is no transmission mechanism to go from the state to the SMEs. And I think if we had more of these funds, then that could have been a catalyst, or could have been a way for you to provide credit, because you're right, they create the most jobs, they're a big part of the economies, And generally speaking, they're the ones that have to pay the most for capital or don't have access to the capital. So there's a lot of work that I think we can do going forward. And there's an enormous opportunity. There is on the sort of public debt market side, but certainly on the private side as well.
Okay, good. And you mentioned the private debt fund that you're working on. What else can we expect from Franklin Templeton? What else are you looking at?
So Franklin is also going through a period of enormous change. I mean, the biggest change is obviously at the end, in a couple of days now, we'll be closing the acquisition of Legg Mason. So that brings on board now another 600-700 billion in assets. I think will be 1.4 trillion. We add another 7 or 8, I think, different respectable strategies that people can invest in. It means changing our distribution to embrace technology. It means also implementing ESG across all of these platforms. It means collaborating with all these different groups so that we can deliver better outcomes for investors. And I think it means more of a commitment, I think, to areas where we see growth. So, Legg Mason wasn't present in a big way, I think, in the GCC in terms of offices here. I think they covered it out of London. But now, I mean, so this acquisition is very complementary in a sense. And I think the commitment to the region will only grow. Now, I think we'll have more products to offer them. And I think the focus on fixed income in the region is definitely because of our GCC bond strategy, but also because of our global Sukuk strategy and our emerging market strategies in general. All of those should be leveraged, I think, as we go forward.
Okay, excellent. I'm going to take another question that's come in, which is, does a seeming decoupling of the financial market recovery from the real economy recovery concern you with respect to the sustainability of the current financial market recovery?
I mean, it does concern me because you do feel that, a lot of these movements, really stem from a failure in a way of the current setup. And then as you start seeing this frustration and this anger manifest itself in the US and in Europe, and then obviously we had it in our part of the world for a number of times. I mean, this creates volatile environments and it creates difficult challenges, I think, for policymakers, but also for financial markets. Now, the disconnect between financial markets and the economy is not something new. I mean, you live through that all the time. In many instances, you have a situation where the economy is doing very well and the financials doing poorly, or vice versa. I mean, take China. It was growing at 7 or 10% for decades, while its financial markets were a yo-yo or would go through periods of bad news. So it's not that this is happening now that this is such a cause for concern, because we know that it's the liquidity that the Fed has provided, and it's this view that the virus will have a limited life, and eventually we go back to a more normal operating environment. So that's not the disconnect is not the challenge, but the challenge is, I think, that the inequality that we have, I think, is going to have an impact on policy. Now, whether it's in this election cycle or the next one, I don't know. We'll have to see who is elected and how things progress. But the debate around inequality, around globalization, around addressing the impact that new technologies is having on the employment markets, these are not topics that are going to go away. I mean, these are going to be with us, and they're going to have pretty profound implications. So, if you told me, how do I think about that? I definitely think about the tail risks, and whenever we can, if we can hedge those out or be somewhat defensive or aware of that, that's something we are very conscious of.
Okay, good, excellent. The final question from myself is something which I'm sure a lot of people ask you, something investors want to know, and I'm sure our audience wants to know as well from an expert like yourself, is where do you think investors should be putting their money today?
Well, other than the obvious in our funds, no. But I mean, again, go back to what we were talking about earlier. The markets or the asset class that have delivered the best risk-adjusted returns are the credit markets, the external debt of emerging markets, especially the higher quality ones. It's U.S. equities. Okay. Those should be, in my mind, the key or the big allocators or the big that take the biggest slice. I think you can complement that with one of the questions earlier, some cash, depending on how people feel. I think gold, I mean, I've been a gold bug for most of my professional life. I've never invested in it professionally, but I've always been aware of, the value it can serve. So I think having something in gold is sensible, especially when there's so much uncertainty around how all of this quantitative easing and monetary policy and the inequality that we were talking about plays out. But those would be smaller allocations. The bulk ultimately has to be in U.S. equities and I think in credit, fixed income credit, emerging market, and then cash, a property if you have it, or some gold, I think rounds it out.
Okay.
In terms of overall levels of risk, I think today you want to be fairly cautious. I wouldn't be very aggressive in the environment right now because we do have quite a bit of uncertainty. And while the policy is making, is dampening, if you want, the vol, and is making these returns or is healing the markets, it's true. And I wouldn't want to stand in the way of the Fed or of OPEC and other policymakers. But I do think that the unexpected, will materialize, and you want to be cautious and you want to be able to take advantage of opportunities as they present themselves.
Okay, good, excellent. I think we've covered all the questions. We've just had another question come in. Any GCC credit ETFs by Franklin Templeton?
That's a good question. I think we need to see our plain vanilla funds scale up a little bit more before we really start pushing these passive strategies. As an organization, we were probably a little bit late to start offering passive strategies, but we have been more recently, and we're trying to catch up. And certainly there is now, I think it's established that I think you need to be able to offer people passive or low cost exposure to asset classes. And as our asset class develops, we need to see this happen. But the question of timing, do we do it now or do we do it later? I think that's still up for discussion. I think the organization would want to see our assets grow to a more meaningful size before they start offering lower cost and more passive opportunities. But to be very honest with you, these types of decisions are not driven by the portfolio managers. These are typically driven by our salespeople, really in response to what their clients are telling them that they want. So if enough people ask for it, then I think we will be more than happy to deliver that.
Good. And just generally on ETFs, I'm a big supporter of ETFs. They're great, especially for your retail investors as well, where they don't have the time to spend doing the market analysis and research, and they just look at ETFs. So I think that's something which I personally see there's a huge potential for the market to grow when it comes to ETFs. So we hope that we do see some more GCC-based ETFs from Franklin Templeton. I think we're done with the questions. Look, Dino, thank you very much. It's been a pleasure having you here. It's always great for me when we have discussions because I end up learning so much, and I'm sure our audience has learned a lot today as well. We hope to see you.
It was a real pleasure. That was fun. Thank you.
Thank you very much. And ladies and gentlemen, thank you for joining us. And we'll see you on our next webinar.
Thank you.
Have a good day. Bye-bye. Thank you.
Bye-bye.